In Q1 2020, Tesla reported $16 million of net income. Tesla sold $354 million of regulatory credits that same quarter. Without those credits, Tesla lost $338 million on actual car operations. That was Tesla's first sustained profitable quarter, the one Wall Street celebrated as the inflection point. It was almost entirely paper revenue from other automakers' compliance failures. Tesla discloses regulatory credit revenue as a separate line in its 10Q income statement. The credits come from California's CARB program, the Federal CAFE program, and EU emissions equivalents. Other automakers, GM, Ford, Stellantis, Toyota, Hyundai-Kia, historically failed to meet EV share quotas and bought credits from Tesla to comply. Tesla generates these credits as a byproduct of every EV it was already going to sell, at zero marginal cost. Tesla then resells them at 100% gross margin. Between 2019 and 2022, this was Tesla's largest profit center. Run the numbers across Tesla's profitable era. Fiscal 2019, $594 million in credits, $24 million net loss. The credits were the entire reason the loss was not worse. Fiscal 2020, $1.58 billion in credits against $721 million in net income. The credits were 219% of reported net income. Without them, Tesla lost almost $900 million on operations. Fiscal 2021, $1.46 billion credits against $5.5 billion net income. Credits were 27%. Fiscal 2022, $1.78 billion credits against $12.6 billion net income, 14%. Cumulative across 2019 to 2022, $5.4 billion of regulatory credit revenue at near 100% margin. That is the equity story. Without those credits, Tesla reports losses across fiscal 2019 and fiscal 2020 and significantly smaller profits in 2021. The stock multiple Tesla traded at 50 to 100 times earnings was built on a profit base that was structurally one-time arbitrage from incumbents being slow to electrify. Walk through one credit transaction. Tesla sells a Model 3 in California in 2020. CARB awards Tesla 3 to 5 ZEV credits per vehicle sold. GM sells a Chevy Suburban in California the same year. CARB requires GM to either sell a corresponding number of EVs, which GM does not do at scale in 2020, or buy ZEV credits from another manufacturer. GM contacts Tesla. Price negotiated bilaterally, typically $5,000 to $15,000 per credit in that era. GM wires money to Tesla. Tesla books the revenue at 100% gross margin. GM books it as a compliance cost in cost of goods sold. The Model 3 was sold at near zero margin in 2020. Production cost matched MSRP for the early Model 3. The credit transaction was where Tesla's actual operating profit came from. The car was the byproduct that triggered the credit creation. Cleanest single data point in the public record. Q1 fiscal 2020. Tesla reported $16 million of net income, the famous first profitable quarter announced March 2020. The stock rose 25% in the week following. Tesla disclosed $354 million in regulatory credit revenue that same quarter at greater than 95% margin. Back the credit revenue out, Tesla operations lost $338 million. The inflection point Wall Street priced in was a paper transaction. By Q2 2024, 4 years later, the picture flipped. GM, Ford, Hyundai-Kia, Stellantis had all scaled EV production to the point of reducing or eliminating their dependence on Tesla credits. Tesla's automotive operating margin dropped from a 16.8% peak in fiscal 2022 to 5.5% by Q4 fiscal 2024, excluding credits. The market started pricing in the reality. Tesla stock dropped 65% from its November 2021 peak to its 2023 trough. Here is what nobody is saying about the credit decline. Elon Musk, on the Q1 2023 earnings call said, quote, We have a substantial inventory of regulatory credits, and we expect this revenue stream to continue at significant levels." End quote. By the Q2 2024 earnings call, he stopped including credit revenue commentary in his prepared remarks entirely. The other automakers Tesla used to sell credits to are now competitors selling EVs. They no longer need Tesla's compliance arbitrage. And the 2025 incoming federal administration has signaled potential elimination of the federal ZEV mandate, which would zero out the residual credit market overnight. Tesla's response: pivot the equity story to robotaxis, full self-driving software subscriptions, and Optimus humanoid robots. None of those generate material revenue today. Lesson: when a company has razor-thin operating margins on its visible product, yet posts GAAP profits and trades at a software multiple, look for the regulatory arbitrage or installed base recurring layer underneath. For Apple, it is services. For Walmart, the supplier float. For Costco, the membership fee. For Tesla, 2019 through 2022, it was regulatory credits. Every one of these hidden revenue lines has a structural lifespan tied to the conditions that created it. When competitors scale or regulation shifts or customer behavior changes, the line collapses. Companies that compound for decades figure out a sequence of these hidden lines, not just one. Tesla is currently betting robotaxi software is the next one. The market has not decided yet.